Hey everyone, welcome to the KE Report in a daily editorial, Monday, August 25th, chatting with Craig Hemke. Craig is the founder and editor of TF Metals Report, also our regular Monday guest talking about the precious metals. And Craig, I think we should first just recap what happened at the end of last week. Everyone was waiting for Powell's talk at Jackson Hole, and he came out and pretty much, I feel like, locked in a rate cut at the next September meeting. And markets, metals, everything outside of the dollar did quite well to end the week. It was a day of a lot of green on the screen, a lot of up moves in a wide range of markets, including precious metals. And the precious metals stocks also did very well. And again, the market's been waiting for rate cuts. It seems like we will slowly start to get them out of the Fed, which has been on pause a lot longer than the other central banks, which mostly seem done or at the tail end of a lot of their rate cuts. Craig, what did you pull away from that Friday's action and anything Powell said?
Well, hi, Corey. Yeah, we entered the week last week. Over the weekend, again, not this weekend that we just concluded, but the weekend before, we just come off of New York Stock Exchange option expiration on the 15th. And I just sense a lot of bearishness, but I recorded a podcast that Saturday at my site, and I was like, yeah, I don't, we should probably set up for a good week next week. But it seemed like the general consensus is that we were not going to have a good week. And early in the week, I don't know, gold fell about 20 or $25. But then it made that back, and then we got into Friday. And even then, it just kind of seemed like there was an expectation that Powell was going to remain hawkish in defiance of Trump and all this kind of stuff. In light of, now that we know what he said and how he said it, it shouldn't really be surprising because, I've had to follow Powell pretty closely for the last 8 years. And if anything, it's always been pretty apparent that his number one most important economic indicator is the amount of jobs every month that get created and the unemployment rate. He focuses on that as his, big macro, sign more than anything else. And you could say, yeah, he worries about inflation. All those things are secondary. He worries about being, what you've heard him talk about it. You're navigating by the stars under a cloudy sky, and trying to figure out what, how to predict where the economy is heading 6 to 9 months in advance, because that's how long it takes for, anything the Fed can do to have kind of a ripple effect. So in hindsight, after the jobs report that we got back on the first of this month and the huge negative revisions, and the massive annual revisions that are coming early in September to all the reports of the last 12 months, the fact that Powell is now leaning toward rate cuts is not, really shouldn't have come as a surprise. Like you said, great for everything except the dollar. Even the bond market rallied sharply back on Friday. And that dollar now will be the key, I think, as we head into September. If it continues lower, it's in a pretty significant downward channel on the weekly chart. Eventually, that's going to carry over and kick the metals to a leg higher, too.
Yeah, that dollar. It has been trending lower this whole year, and quite frankly, it could break even lower considering the environment that we're in, where, again, Fed's going to be cutting rates, rest of the world mostly on the back half of rates. What about the COT report? We constantly talk about the commitment to traders reports, how traders are positioned. Let's start with gold. Any changes that you've noticed, Craig?
Yeah, everybody knows how that report kind of ebbs and flows, right? You get a big leg up in the futures prices, typically on the backs of speculators, large and small hedge funds, whatever, buying futures, getting all excited. And then they reach kind of a level that's a point of buying exhaustion, and then price rolls over, and those same speculators get flushed back out, and that selling moves price back down. And then you get back to a point where everybody that had rushed in last time pushing price higher is now rushed back out. And that's, at least as of last Tuesday, that's where we were. These reports come out every Friday, but they come out 74 hours after they were surveyed at the COMEX close on Tuesday. And you go back to last Tuesday, that was a day gold was down $20 and silver was down 60 cents, and a lot of nervousness and fear going into the rest of the week. Well, on the COT reports that were surveyed Tuesday and reported just back on Friday, the 22nd. Actually, the total net positioning of the speculators, hedge funds, if you want to look at it internally, was some of the lightest, I guess you could say most bullish because it's light, that we've seen in months. The gold commitment of traders was about the best it had been in 6-7 weeks, back before gold had its last run up toward 3,500. Silver's even better. The net positioning of the speculators in silver is as small as it's been since late April. And you go back then, we were kind of coming out of that washout with the tariffs back in early April, but price was around 33. It was as the speculators and the hedge funds rushed in and drove that net long position larger that took price from 33 to 39. Well, now it's washed back to whatever it was late when the survey was taken, 37, 37.50, and we're back to that same level of spec involvement on the long side. So anyway, long detailed answer to what was really a pretty simple question. The COT reports are about as bullish as they've been in a while, and certainly not a hindrance to a rally at this point. If we can just get the spark that would drive these speculators back in on the long side.
For something like gold, we've been talking about this for a while. The gold has moved sideways for 5 months. Really, it's consolidated a lot of these gains. Everyone's waiting for the next leg, whether it be higher or lower. So is this what you would expect from a COT report in a market, a metal that seems to still have a lot of inflows into the physical ETFs, but the price hasn't really gone anywhere? So does that correlate to what you're seeing in those COT reports?
Yeah, it kind of wanes a little bit. It ebbs and flows, like I said. And, the longer you sit in a range, you can imagine you're a hedge fund manager and like, man, this gold just isn't going anywhere. I'm going to start trimming my position and taking some of these longs off and putting money someplace else. You do that in mass, and collectively, as a group, their position gets smaller. And that's what's happened. But the fact that gold has gone sideways for 4 months, as you said, is not surprising. That's the pattern that it has held for almost 2 years now, coming off the lows in about October of 2023. You get this breakout rally of about 15 to 20%, a consolidation for 2 or 3 months, and then another breakout rally of 15 or 20%, and then a consolidation. This most recent breakout rally was even greater, more like 20 plus. And so the consolidation maybe is taking a little bit longer. The only good thing about price ranges I've kind of found over the years, Corey, is the longer they go on, the more obvious they are. And so when they resolve, whether it's to the upside or the downside, it gets people's attention, right? I mean, you could consolidate for a week and nobody'd notice. But when you go on for 4 or 5 months, and then all of a sudden you break out to the upside, it's like, oh, then you get this kind of FOMO trade kicking in again. Okay, finally, this is back on. And that's when the gates, the speculative gates open, and here comes all that cash again. So I'm not concerned by gold going sideways. It kind of aligns with the dollar going sideways over the same period of time. And that's why we'll just see what the next trend is. And we'll watch that dollar closely. Again, if we're moving toward more rate cuts, and even perhaps more than what people are expecting, even this year, if the next jobs report is terrible in a week and a half, then the dollar's going to wash out and start making new lows for the year, and that ought to be enough to push gold up to new highs on the year.
Craig, I'm curious what you have to say about really the way that I see this bull market playing out and my next hope for the continuation of this bull market, where it was a while ago now, well over a year ago, that gold made a breakout. The majors were doing really well, and select stocks, the whole way down to a couple juniors, were doing very well. They had new stories. They acquired different projects. They really did something to garner that attention. And then in the last couple months, we saw the juniors pick up steam. There's been a complete revaluation across the board for juniors, and probably 90% of those juniors. And we also keep hearing about the breadth indicators of how many stocks are at 52-week highs, how many are above certain moving averages. And this is all well. Gold has moved, again, sideways for 5 months. But now I feel like this sector's come to the point where we need another leg higher in gold to keep that momentum and to also justify these revaluations and then be able to make the argument that, look, the stocks need to re-rate again because gold is so much higher. It's not at the same level it was 4 or 5 months ago when these stocks have doubled or tripled in that time. What's your thought on how this all needs to play out if this truly is just a continuing bull market?
Yeah, agreed on almost everything you said, Corey. One part of this is the kind of pyramid that we've always discussed. That I don't know if it's a true paradigm of the sector or not, but like the majors move first, followed by the juniors, followed by the exploration companies, right? And I can certainly see where I got a basket full of those babies that I own, that the exploration, the tiny guys that haven't moved yet. And if you'd have told me 2 years ago that we'd be talking $3,400 gold, I'd be like, oh man, that thing's at 20 cents, going to be $2, right? And it hadn't happened yet. So maybe in a way, we're just kind of moving through that pyramid that we've all always talked about. In terms of prove it, that's absolutely right. You remember right after Newmont and Agnico reported earnings in late July, the dollar started to rally and gold started to fall. And those, even though they had great numbers for the second quarter, those stocks started to fall too. And it was like, to me, investors looking at that and going, yeah, well, that's nice. You made it in the second quarter, but if gold's going to pull back now to 3,000 or 3,100, you're not going to make it in the third quarter. So that's as good as the news is going to get. So now I'm getting out. Well, then as soon as gold turned around after the jobs report on August the 1st, it starts moving up again. Wow, right? All new all-time highs in Agnico, and here's Kinross at $20 and the GDX at the highest it's been since 2011. So it's like, as soon as we get deeper into the third quarter now, which only has 5 weeks left, and the average gold price is actually higher than it was in the second quarter, it's like, well, hell, I guess they're going to have great numbers again. And so, yeah, so that it almost has to prove it just by at least going sideways, if not break out. Then the last thing, you can see this in the chart of the GDXJ. And I've wondered if the thing isn't like self-confirming in a sense, because you can pull up the chart of the GDXJ, which, just got slaughtered from 2012 to 2015. It is gradually rebuilt and now is up to whatever it is, 75. Well, on the chart, I mean, it looks like once it's above 70, the next target is 90, maybe even 100. Well, heck, I mean, that's another 20, 25% from here, which then is that, okay, if that chart's telling me that it's going to 90 or 100, another 20% higher, under what conditions would it be doing that? Well, probably a higher gold price. So I don't know if those dots connect, if that's just, a circular logic, but you can kind of, in a way, see how that could work. We're in a seasonally strong period for gold. Usually September is a pretty good month. Like I said, if we can get some help with some lousy data as the month begins, or continued lousy data, jobs report, that kind of thing, and get the dollar to start falling, at least gradually moving lower again, yeah, we might get that next breakout and the whole prove it and another big leg up in the shares.
Now, how about silver? Do you think silver could lead another leg higher, or will it, as it usually is, kind of follow along gold? Once people get comfortable, make their profits in gold, filter that money down into silver, and that's when it could have that breakout, who knows, up towards that almost magical $50 number that everyone looks at.
Yeah. Do you remember us, you and Shad and I, talking about this before silver went from 33 to 39? Remember I described it like what was it, Newton's law of inertia or whatever the heck it is. Remember these discussions, Corey?
Oh yeah, we talk about it a lot.
Yeah. And how silver just sits there.
Yeah.
And nobody, it's like, why do I want to buy it at 33? It just, it sits there, it starts going. Then once it starts moving up, once a force is applied to it, it starts rolling. And then it starts rolling faster and faster. And you get that FOMO trade, and these speculators rushing in, and it goes up 20% in that move. Well, so now here it is again, kind of hanging in there, 37, 38, but not really moving up yet. I think the next leg's coming. We've known each other long enough, Corey. I'm not I'm not the guy that's like, it's going to be $80 by Thanksgiving, clickbait kind of stuff. But I do think, and I wrote this in January in my macrocast, I think it can get up to 41 or 2. Then maybe, who knows, pull back into the high 30s by the end of the year as everybody's waiting and see what's coming in 26. Even though I'm not the $80 guy, you're right. Once it gets to 50, 48, and hangs up there, and even if it runs into resistance for a while, that's going to get a lot of attention because eventually it will break out and people are going to go bananas when it does. I think that's coming next year. I think there's a combination of macro and monetary events that are coming for next year that if you read between the lines and follow the headlines every day, I think you can start to connect these dots. And under those conditions, I think next year's going to be there's going to be some crazy times in silver. But for now, I wouldn't. It's pretty cool that it's hanging in there, right? I mean, silver's got when it's gone up to 48 in the past, it's almost been like intra month. It rarely. I mean, I think as somebody posted the chart of the 200-day moving average is like 33 or 34. It's like it's higher than it's ever been because the price has never gone up and stayed up in this area. It almost seems like it's staging for something. Hopefully that'll be some fun in the near future.
Well, we'll see if it comes to next year or later this year. But I guess just more in the near term, you mentioned how next month, September, is seasonally a good month. We're also going to have people back from their vacations, their trading desks, wherever they might be. Summer is usually a slower time. This summer has been busy. Expecting anything in just the next couple weeks as the calendar turns over and more people, I think, simply pay attention to the markets?
Well, yeah, September always gets busy, right? Because like you said, like here in the States, well, think of all the New York guys running on the prop desks that they've got kids that are going to start school after Labor Day, and they all want to go have one last weekend at the Hamptons and all that kind of jazz. So we've got our Labor Day holiday next Monday with markets closed, 3-day weekend. There's going to be some news on Friday, the PCE report, inflation report. And then after that, it's going to get quiet. Now you get into September, and it could go either way. I don't want to make it sound like, it's all good time rock and roll here. Friday, September the 5th will be the next jobs report. If even crummy the number for July, if that number gets revised down, to 20,000 like May and June were, if the number for August comes in lousy, then there's going to start being this talk about, well, maybe 25 basis points and maybe they're going to do 50. And then the week after that, I think it's on the 9th or the 10th, the BLS is going to have a whole 1 year adjustment. Remember they did this last year right before the election, and it was like there was 840,000 jobs that they overstated. Remember all that? And people were like, see, they're just making it up for Biden. Well, they're going to do it again. And I've seen numbers could be as high as 1 million jobs that they overstated in the last year. Well, okay, so that number comes out. How does that impact the September FOMC, which is 3 weeks from now, 3 weeks from this coming Wednesday? So all of that. Now, it could be, hey, look at it, 200,000 jobs, and revisions upward and all that kind of stuff could completely kill the narrative. And we might be back to questioning whether there'll even be a 25 basis point rate cut at that meeting in 3 weeks. But if the data goes south and if the jobs report is terrible and there are huge revisions again, I could construct for you a very bullish scenario where we're talking 50 basis points again in September like last year, the dollar sinking to new lows for the year to date, and the metals breaking out. So it's going to be a real busy 3 weeks, I guess, is my long answer to your short question.
Hey, good answer, Craig. I'm sure there will be a lot more news, and who knows, maybe some more market moves in terms of the metals. But throughout this summer, the stocks have definitely played catch up. Got to be encouraging for everyone looking at their portfolios because I've noticed it almost across the board in terms of stocks that have revalued. Craig will wrap it up here, though. Again, Craig Hemke is the founder and editor of TF Metals Report. Click the link in the show notes to follow along with Craig's market commentary. Craig, thank you as always for your time. Have a great rest of your week.
You too, my friend.